welcome back with me. Don't forget to like, share, comment, and subscribe. London Reuters stock fell on Thursday ahead of more interest rate increase from central banks to cool decided high inflation, with Sweden leading a round of anticipated hefty hikes from its US, Swiss, and British counterparts later in the week. Shares in Europe turned lower by mid-session after US stock futures issued, with the Federal Reserve kicking off a two-day meeting. The dollar was near to the Fed hike versus major peers, underpinned by expectation that the Fed will unveil another rate increase when its meeting ends on Wednesday. Crude oil prices were steady, but Eurozone bond yields hit new multi-year hikes as German producer prices rose in August at their strongest rate since records began, stoking worries about even higher inflation. US stock futures were down about 0.35%. The STOXX index of 600 European companies gave up initial gains to yields of 5%, compounding a 16% rate for the year, as follows from a war in Ukraine and rising inflation and borrowing costs. Full recession fears. Sweden's central bank hiked rates by a greater than expected full percentage point on Tuesday and warned of more to come, a stark reminder for investors that tackling inflation remains a work in progress for many central banks. Hikes from the Bank of England and Swiss Central Bank are expected on Thursday, putting more pressure on stock markets. Tighter monetary policy around the world will increase the headwinds for risk assets. After all, central bankers are deliberately trying to slow aggressive demand, ING Bank said. Markets are poised for US rates to climb as high as 4-5% by early 2023, compared with the Fed current 2.25% of 2.5% policy rate hike. Lucas Paulini, chief strategist at Protect Asset Management, said the US Central Bank would likely see the pace of hikes going into next year. The market, in a way, is probably expecting a peak in rates, Paulini said, adding that market focus would then switch to how higher rates were affecting economic and company earnings. We haven't seen it yet fully. I believe a significant downgrade in earnings, which I think will come. The downside for bonds is limited, Paulini said. Inverted yield curves or long-term interest rates below short-term rates were also a red flag historically to buying shares. He headed on a more positive note for stock. The books for Volk when falsely anticipated initial public offering of Prox AG on September 29 are covered multiple times over. Graphic 2-year Treasury held approach 4%. Bond yields risk. China's central bank keeps in benchmark lending rates unchanged and a monthly easing on Thursday as expected. The only exception is the Bank of Japan, also due to meet this week, and which has shown no signs of abandoning its ultra-easy yield course policy despite a drastic surge in the yen and inflation hitting its fastest pace in 8 years. Just because nobody expects anything coming from Japan, the central bank, there could be the more interesting one this week, because any hit they are going to change anything could have massive implications for the yen, Paulini said. share trending tourism in Japan on Thursday after a national holiday. Okay, maybe that's all from me. Thanks for watching. Don't forget to like, share, comment, and subscribe.